setting a tariff for essentially the rest of the world, and that's what they're going to pay if they want to do business in the United States.
What happened to 90 trade deals in 90 days?
We've spoken to everybody. We know it's all done.
I think with Vietnam, the UK, with China, not all those are intended to be final deals either.
At the start of August, President Donald Trump declared victory. His global tariff campaign forced allies into quick agreements before his deadline. The promise was stability, with tariff caps around 15% in exchange for huge investment pledges in the United States. On paper, it looked like a win. In practice, details remain vague, and industries in partner countries still feel the strain. Washington's message is simple: invest big or face higher tariffs. That has left allies from Europe to Asia weighing short-term relief against the burden of massive commitments and the risk that Trump could change course again. Japan's auto sector shows the limits of these deals. The World Trade Organization reported that the average U.S. tariff rate now exceeds 20%, the highest in more than a century. For Japanese car makers, this is a real cost.
Short term, we have to brace for the impact. We'll work hard to find a way to overcome these incremental costs.
Mazda expects almost $1 billion in extra expenses this year. To cope, it is ramping up output at a $2 billion plant in Alabama, built during Trump's first term. That investment softens the blow, but half of Mazda's cars are still produced in Japan for the U.S. market. The company also relies heavily on a large factory in Mexico, which remains exposed until Washington finalizes terms with Mexico. The result is uncertainty, not stability. Europe's metal sector is in a similar bind.
Negotiations, European Commission President Ursula von der Leyen says the framework trade agreement with the US will provide support for Europe's metal sector freight, but details remain in short supply.
Brussels reached a framework agreement with Washington, promising tariff cuts and a quota system. Yet steel and aluminum still face a punishing 50% duty. The quota system, which should allow some duty-free exports, is not yet defined. The European Steel Association says U.S. tariffs have already damaged an industry worth more than $90 billion a year and weakened by falling demand. Business leaders warn they remain in the dark, with little more than promises to rely on. These examples show that rushing to sign has not removed the pressure. Canada took another route. Ottawa refused to sign under pressure, accepting a 35% tariff on goods outside CUSMA as of August 1st. That sounds severe, but CUSMA continues to exempt the vast majority of Canadian trade. According to Scotiabank chief economist Jean-François Perrault, between 85 and 95% of exports remain tariff-free under the deal, when averaged, Canada's effective tariff rate is about 5 to 6%. That is painful, but still lower than the 15% rate faced by Europe, Japan, or South Korea. Although Canada has felt the pain of Trump's tariffs, the country is turning its focus inward. Rather than tying its future to Washington's demands, it is strengthening itself at home.
We've got a lot of work to do on major projects, on affordability, on security in our communities.
This was clear in the recent meeting between Prime Minister Mark Carney and Ontario Premier Doug Ford in Ottawa, where leaders emphasized building national competitiveness and resilience. Some Canadians question whether the government is being too passive in the face of Trump's tariffs, but the data suggests that Canada has avoided the most punishing outcomes while keeping leverage for future talks. Unlike partners that promised hundreds of billions in investments, Canada has not mortgaged its long-term position for short-term relief.
What the Prime Minister actually said during the election campaign. No deal is better than a bad deal. And so we're not going to be in a hurry to sign a bad deal.
The contrast is clear. Nations that rushed to sign before August 1st now face heavy investment costs and lingering uncertainty. Japan's car makers and Europe's steel industry show that the pain did not disappear after the agreements. Canada, by holding firm, absorbed targeted damage in specific industries, but kept the broader economy intact and its negotiating position alive. This is not surrender. It is a strategy of endurance. With energy exports, critical minerals, and an integrated supply chain, Canada remains a partner the United States cannot easily replace. Trump may continue to escalate, but Prime Minister Mark Carney's approach shows that strategic patience is the strongest counterweight to Washington's unpredictable demands.
Following the Swiss president's failure to reduce tariffs on her country after a visit to Washington earlier this week, the Financial Times is reporting that the U.S. has imposed tariffs on imports of 1 kilo gold bars, dealing a further blow to Switzerland, which is the biggest player in gold refining.
In early August 2025, Washington sent a jolt through the global markets. President Donald Trump's administration confirmed a 39% tariff on imported gold bars, hitting Switzerland, the world's largest gold refining hub, head-on. It wasn't just a blow to a small European country's exports. It was a message. No commodity, however entrenched in global trade, is beyond the reach of Trump's tariff playbook. For Canada, watching from across the border, this was a clear warning. If gold can be pulled into the fight, so can other high-value sectors.
The only thing I can tell you from a European perspective right now is that all shipments are on hold. So basically, there's no trading of gold bars between the Atlantic.
Until the first week of August, traders believed bullion would be spared. Gold bars in the 400-ounce form for central banks, the 100-ounce size traded on COMEX, and the 1-kilogram standard used in Asia were assumed to be outside the scope of tariffs. That changed when a Swiss refiner received a formal letter from U.S. Customs confirming that under tariff code 7108-13550, these bars would face the full 39% duty. The immediate impact was severe. Gold shipments between the U.S. and Europe halted overnight. U.S. gold prices climbed above European levels, opening an arbitrage gap. According to U.S. trade data, imports had surged earlier in 2025, 43 metric tons in January alone, nearly double the average monthly U.S. refining output of 22 tons, as buyers tried to front-load shipments before any policy change. Now, those stockpiles are all that's left to bridge the supply gap. For the global gold market, this was more than a price shift. It was a sudden rupture in the supply chain. For Canada, the lesson is straightforward. Gold may not be a major export to the U.S., but the same logic could apply to Canadian strategic minerals, energy products, or even high-end manufacturing. Ottawa knows that even sectors long considered safe under USMCA can be targeted. The gold shock proved how quickly decades-old trade flows can be disrupted by a single enforcement letter. And with Trump's focus on bilateral trade imbalances, Canada's own surpluses in certain commodities could attract the same kind of attention Switzerland just received.
We have a lot to do in this country. We have a lot positive to do in this country, building this country in a way, building one Canadian economy.
I have all the confidence in the world in the Prime Minister. Donald Trump is very, very hard to deal with just because it's so fluid.
This is why Prime Minister Mark Carney's approach carries even more weight in the current climate. While Ford hits back publicly with numbers, Carney is quietly keeping negotiation channels open, even as Canada faces the 35% rate. He is deepening trade cooperation with Mexico, expanding links with the EU, and safeguarding domestic industries against sudden U.S. policy shifts. Canada's leverage lies in what the U.S. needs: strategic minerals, energy, and integrated automotive supply chains. The gold tariff episode only reinforces Ottawa's push to diversify export destinations and prepare contingency plans. From steel and aluminum to copper, and now gold, Trump is targeting sectors where the U.S. can exert maximum short-term leverage. The element of surprise keeps opponents off balance. It's a tactic designed to push trade partners toward concessions before they can rally a coordinated response. But with Canada, the strategy has met resistance. Carney and Ford are aligned in rejecting a bad deal and in showing that Canada will not simply absorb U.S. pressure without a counterplan. For Canada, the gold tariff is more than a dispute with Switzerland. It's a warning shot. Ottawa is combining public pushback with measured diplomacy, signaling it won't be outmaneuvered. The contest is no longer about who can raise tariffs higher, but about who can adapt faster to the shocks still to come.
President Trump hit Brazil with a 50% tariff, the steepest against any nation. Trump's politically charged tariff on the U.S.'s largest supplier of coffee.
This is something to definitely pay attention to because it will mean higher coffee prices.
Morning routines in America often begin with something simple, a hot cup of coffee. For many families, that first sip is more than caffeine. It is a ritual that sets the tone for the day. But even that small comfort is no longer immune from politics. After President Trump imposed a 50% tariff on Brazil, the world's largest coffee exporter, prices began to climb sharply. A pound of ground coffee that cost $6 last year now sells for about $8. For importers, invoices that once totaled $10,000 now arrive at $15,000. Small cafes say the extra cost could decide whether they survive. This is not an abstract policy debate in Washington. It is a daily expense that lands on the checkout receipt of millions of households. What was meant to punish a foreign country is making mornings more expensive in the United States. Coffee is only one product. When tariffs spread across metals, food, and manufactured goods, the impact becomes unavoidable.
Watch, the U.S. economy has a case of foodflation.
Coffee up nearly 15%. Ground beef up just over 11%. Egg prices hit by avian flu are falling, but still up more than 16%.
There's no doubt Americans are paying the tariffs at this point.
The Bureau of Labor Statistics reports that wholesale prices for fresh vegetables surged at a record pace in July. Overall grocery costs are up 2.2% compared with last year. Coffee is nearly 15% higher, ground beef more than 11%, and eggs remain 16% above last year's level. Aluminum and steel tariffs, introduced in March, now show up in canned goods, beverages, and food processing costs. Wholesale inflation climbed 0.9% from June to July, the sharpest monthly increase since June 2022. Economists had expected only a modest rise, but tariffs have sped up the pressure. At first, large retailers absorbed part of the burden, but that cushion is gone. With supply tightening and costs rising, families face fewer choices and thinner budgets. If grocery bills show the hidden tax of tariffs, tourism shows how those policies ripple through entire communities. Canada remains one of America's closest economic partners, yet relations changed on August 1 when Trump raised tariffs on Canadian goods outside USMCA to 35%. In response, Canada has turned to diversify exports toward Europe and strengthen cooperation with Mexico.
What happens in Vegas could spell trouble for the U.S. economy. Empty streets and casinos.
It's slow. When I drive down the strip going to work in the morning and I barely see visitors out there.
The tariffs were meant to squeeze Ottawa, but they are already hitting American communities. Tourism shows the clearest effect. According to the Las Vegas Convention and Visitors Authority, total visitors in June fell more than 11% compared with a year ago.
President Trump's tariff announcements angering potential visitors like Canadians.
Used to we have like lot for Canadian, and now no.
Flights from Canada dropped over 18%. Hotels, casinos, and convention halls counted tens of thousands fewer guests. In a city where a quarter of workers depend on tourism, the absence of Canadian visitors translates into real losses for restaurants, entertainment, and local businesses. What was designed to extract concessions abroad is instead draining revenue from America's own economy.
A vote for Trump means your groceries will be cheaper.
Trump promised tariffs would put America first. In reality, they are circling back onto American households and businesses. Coffee is pricier, grocery bills are heavier, and tourism is weaker. The weight falls inside the United States, where families and local economies bear the cost. Canada, meanwhile, is not yielding. It is adapting, finding new markets and holding leverage. This contrast shows tariffs are not forcing neighbors into quick concessions. Instead, they are exposing America's own vulnerabilities. The story of tariffs is not written in speeches, but in daily life. It is printed on grocery receipts, in tighter budgets, and in the empty hotel rooms of Las Vegas. What was billed as a show of strength abroad has become a bill handed to the American people.